so on the one hand, because I know in your part 3 of the series, you also connect the value premium to market volatility regimes. And you sort of demonstrate, during periods of high ambient volatility, and I think you use sort of 1966 to 1944 as a period of fairly high volatility, and then this great moderation from 44 to 75, very low volatility, and then a subsequent period of higher volatility, and you show that the value premium is highly explained by the volatility regime, right? So there's that component, which I find very intuitive, but then there's also this other component of the probability of migration, which so to the extent the premium is a function of the carry on Vega from selling options and the probability of migration. So if Vega is small, then you've got a lower expected premium. If the probability of migration is small, you've got a lower expected premium. So you've got these sort of competing dynamics. And so what does that say about the prognosis for value, systematic value, as your thesis plays out?
Well, if I'm correct about the continued migration into passive, right, you're effectively talking about a higher and higher fraction of stocks that just get frozen, right? And so it's part of the reason why I emphasize that if you really did this properly, you would convert it to an outperformance option as compared to a vanilla option.
Right.
I'll leave that for someone younger and smarter than me, but having shown the path, I can let somebody else do some work for a change.
Well, yeah, but the drift term is small, right? Like, I mean, if it depends on the rolling frequency, but if the rolling frequency is sort of monthly or quarterly, then the average drift term is very, very small. And so you can almost, and I know you're going to argue that drift term is not priced in option theory. And so there's a convexity there that you could take advantage of. But notwithstanding all that, I think you can actually eliminate that drift term to a large extent if at a fairly high rolling frequency. And I agree you'll get greater precision if you use the excess, but you get qualitatively in the right direction.
Exactly. And that's why it's just not worth the extra calculation from my standpoint. I feel fairly comfortable that we've actually demonstrated the mechanism that ironically fits actually with Ken French and Eugene Fama's reformation as they came back and revisited it and said, hey, we're not entirely sure this exists anymore. We can't disprove it. But here's actually the source of the returns. And they highlighted the migration dynamic. The irony is that most people, it's very hard for people to think about stocks as actually options, right? And, that's happened in a variety of ways. I had a conversation that's going to go on to Real Vision in a couple of days, speaking with Jamie Catherwood of O'Shaughnessy Asset Management, who's a brilliant young historian in terms of the financial markets and just a lot of fun to talk with. And there are changes that we have made in terms of the dynamics of capital structure that make equities option-like, right? So if we went back to the 19th century, if you bought shares in a company, you became liable for its debts, right? Which meant that there was a two-tail component associated with buying equities. The minute you eliminated that, you can actually see this in the data, that there was a mechanical step up in valuation for equities that occurred in the 1860s as that became standard, right? And it's because you'd abrogated the left tail. You could argue that there's some similarities to the idea of a Fed put, right? If the Fed is going to take away the left tail outcomes, that raises the valuation of equities. And so I think those things all contribute to this type of behavior. But this broader thought process of what is a payoff function, which is really what options analysis is all about, right? Identifying the payoffs and pricing them properly, it really hasn't penetrated into the valuation markets, right? People just haven't. The valuation theory has become, ironically and not ironically, as you might expect, as valuation does a worse and worse job of explaining returns, people seem to care less and less about what's actually true about how to value stuff.